Happy New Year and welcome back to Actual Investing. Today we're going to talk about 3 AI stocks that are popular and talk about whether or not they're a buy, in my opinion. So we can't talk about AI stocks without talking about everybody's favorite AI stock, which is Palantir. So let's just start right there with Palantir. I have always been skeptical of Palantir, and I think it's because it was a quote-unquote meme stock, and I, just being the contrarian that I am, wanted to stay away from anything that sounded like a meme stock. So I never really gave Palantir a fair chance, but the more I look into them, the more that I'm liking what I'm seeing. I think that Palantir has a lot of things going for it. So let's talk about that. I'll keep it brief because lots of people on YouTube talk about Palantir. So if you want a deep dive, there's plenty of other people, but I want to try to talk about 3 stocks as quickly as possible and save your time here. So Palantir is an enterprise AI software. And I think that term gets thrown around a lot, but an enterprise is essentially just any large business, government, any entity that could use AI software capabilities. So the thing with Palantir that they're very proud of is that they have the majority of their revenue from governments. So government is their largest segment. You can see down here, this is their income statement breakdown. About 300 million of their last quarter revenue came from government, whereas 251 million came from commercial. That's a double-edged sword because yes, having the government as a customer is a great thing, right? The government has deep pockets, they're stable, but at the same time, there's a lot of considerations about having the government as your key customer. And this isn't just the American government, this is governments in general. Palantir does sell their software internationally, but they only sell it to countries that their CEO, Alex Karp, thinks are good. So there's a little bit of a political bias maybe, but I'm not too worried about that. What I'm worried about is that any kind of geopolitical events could impact government spending, and also administration changes in the US could impact government spending. So I think that's going to add volatility to the stock, having such a large concentration in government. But what I like to see is that look at the growth. Government is growing at 12% year over year, whereas commercial is growing at 23% year over year. So commercial is growing twice as fast as government revenues, and I like to see that. I would like them to diversify more into the commercial segment. I don't know if that's their plan or if that's just how it worked out, but regardless, I really like to see that. And you can't deny that they have had strong growth with profitability. The only thing that I would like to see is I'd like to see them address their falling NRR, which is net retention rate. It's also referred to as net dollar retention, or NDR. And that essentially measures how much more your current customers are spending year over year. So their current NRR, or NDR, is 107%, which means that every year their current customers are spending 7% more than the previous year. Well, not every year, but let's say this year they're spending 7% more than last year. And yes, that's good. We want it definitely to be over 100, but that's actually not terribly strong in the SaaS world. And I personally would chalk that up to macroeconomic conditions. I think the economy has just taken a toll on lots of SaaS stocks, and everybody's NRR is falling. So I think that's something to watch if you're a Palantir investor, and just make sure that that does start to improve, or at least does not worsen. So let's look at their financials here on Google Finance. I love to use Google Finance. It's free. It's accurate from what I've noticed. So this is their income statement. I love to see this consistent revenue growth. And look at that. The past 4 quarters, they have had positive net income. Amazing. So typically with hypergrowth stocks, you see them investing heavily in the business to capture market share. So they will not typically have positive net income. But Palantir says, you know what, we can do both. So they just switched and turned a profit and said, we're going to keep growing and turn a profit. So man, that's some good management. Say what you want about Karp, but I like to see that. And their balance sheet is just beautiful. Look at this. So they have 3.3 billion in cash, and they don't even have $1 billion in debt. So they could pay off all their debt today and still have $2 billion to invest in the business. That's just a business that is thriving, and I love to see that. So I think at the right price, Palantir makes a compelling investment. So let's go on now to Soundhound. And Soundhound was suggested to me by a lovely video viewer. So thank you for the suggestion. I have heard of Soundhound, but it was nice to do a deep dive. I'm going to tell you up front that I would not touch this stock. But let's talk about why. I'm not just going to bash it for no reason. So the technology behind the stock is very cool. So they're a natural language processing company, which essentially just means they use an AI live chatbot. So you know how if you go to ChatGPT and ask it questions, it'll type back. With Soundhound, it'll respond in a human voice, which is very, very cool. And so they can be used for, let's say, a restaurant that wants to take orders over the phone. You can use this conversational AI to accept orders, and it can say, what else can I get you? And will that be, and it's a very cool technology. The thing I don't like is their financials. They're just so ugly. So Soundhound makes money primarily from royalties. They make money in three ways: royalties, subscription, and a blend. But right now, royalties are their primary moneymaker, and that has led to some really inconsistent revenues. I'll show you their income statement in just a minute. But the other thing I don't like is that they laid off half their workforce last year. So I understand that they're trying to turn a profit, which is nice because they are burning a lot of cash right now. But a hyper-growth company can't just lay off half its workforce and continue to grow. I fail to see how that company is going to thrive when they've just laid off 50% of their workforce, half their workforce gone, and they're going to try to continue business as usual. That's very extreme, very, very extreme. One other thing I want to look at here, this is right from their income statement. You can find this on Yahoo Finance. One thing that legendary investor Warren Buffett looks at is your operating expenses as a percentage of your gross profit. And I say I mean a company's gross profit. So this is a screenshot from Soundhound from their most recent 12 months. And you can see they had a gross profit of $28 million on revenues of $38 million. So nice gross margins. But then we come down here and we see that their SG&A, selling, general, and administrative, basically anything from staffing to advertising, is 48, almost 49 million. And on top of that, their R&D is double their gross profit. So they're spending double their gross profit on research and development, and they're spending more than their gross profit also on SG&A. So how is this firm going to become profitable when they are spending so much on R&D and administrative? And I understand that they laid off half their workforce. So yes, SG&A is going to come down, I would expect. But one thing that Warren Buffett talks about is that a company that spends too much on R&D doesn't actually have a competitive advantage. They just have good R&D. And so that's kind of what I'm seeing from this company. They are spending double their gross profit on R&D, and they are just barely growing, and I just don't see how that's going to continue. So I don't like to see that. I don't think Warren Buffett would like to see that. So let's take a look now at Soundhound's financials, and you can see what I'm talking about. So here's their income statement. We see wild inconsistency because their revenues come from royalties. Look at this. They had 2 quarters of negative quarter-over-quarter revenue growth before they finally started increasing it. And that's because royalties are so inconsistent. They need to, and I think they're planning to, but they need to continue to move towards service revenues, subscription revenues, that SaaS model, which will give them a nice little stair step that we saw in Palantir. And the other thing, look at this balance sheet. So in December of 2022, they were totally underwater. Liabilities of 73, assets of 38. That is negative shareholders' equity. That is not good. What I'm assuming happened here is that they did an offering, and I'd have to look into it. So if that's wrong, please correct me. And they raised some cash. But look at that. Their cash is still dwindling. And so to see them have 96 million of cash while they're burning 20 million a quarter, that tells me they've got 5 quarters at this current rate before they're going to need to change something again. So I just don't think this is a company that's going to be competitive, and I would not invest in this company. All right, let's go on to my third stock today, which is a surprise stock that you might not think is an AI stock, but it totally is, and that is Synopsys. So Synopsys makes software to design semiconductors. So to me, I invested in Synopsys because I think it's a great way to sort of quote unquote invest in NVIDIA without actually investing in NVIDIA. So Synopsys partners with the semiconductor designers to help them design better AI chips faster. So it's an AI company for AI companies. I just think that's the coolest business model ever. And I love that it's a software business as opposed to NVIDIA that's more of a hardware business. So right now, the reason I think it might be an attractive buying point is that they've just bid to acquire Ansys, ticker ANSS. And Ansys is used to simulate models of structures and electronics, which I think fits really nicely with Synopsys' business, which is designing semiconductors. So they can use Ansys to simulate computer models of the semiconductors. And I just think that those businesses are going to correlate really well. And Ansys is a nice, big, safe software company, so it's nice to see them, two big giants kind of merging together. The price has fallen because typically when a company makes an acquisition, the company making the acquisition falls in price and the company being acquired rises in price. That's because the company that is making the acquisition is going to have to shell a lot of cash, and the merger has yet to be proven. So I think this presents an opportunity for Synopsys in the long term. So let's look at Synopsys here on Morningstar. I tend to use analyst ratings as more of a guideline rather than a hard and fast rule, so please take this with a grain of salt. Morningstar thinks that Synopsys fair value is 480. Today it's trading about 500, so they think it's fairly valued, maybe a little bit overvalued. And what they're saying here is that they think that they may be overpaying for Ansys. To me, I'm not terribly worried because the company does have good financials and is in a very fast-growing sector. And what I like about Synopsys is that no matter which semiconductor company, quote-unquote, wins, Synopsys will benefit because they provide the software to all different types of semiconductor companies. So if you're trying to decide, oh man, do I invest in NVIDIA or AMD? Why not Synopsys? So let's go to my spreadsheet. Let's start with Palantir. My spreadsheet is getting quite long, so I just got to find Palantir here. Here's Palantir. So Palantir has a score. Oh, and my spreadsheet I rate on 4 metrics. I sometimes forget to talk about that. But the metrics I rate on for growth stocks are revenue growth, valuation, margins, and revenues. So I give a higher score to companies with larger revenues because it's harder to grow larger revenues. I give a higher score to companies with better growth, better margins, and a lower valuation. So Palantir's score is a 10.4, which is a little bit below average. My average is around 11. The thing that's hurting Palantir is just their valuation is very high. But it's also a software as a service company, which has predictable revenues and tends to benefit from a higher valuation anyway. Their margins aren't anything to write home about in terms of a SaaS company, but they are quite good. They're not spending very much on R&D, which is also good, which means they can potentially have a competitive advantage. All right, let's look at Soundhound. Soundhound has a very, very, very low score. This is, again, my investment methodology, so it might not be for everyone, but to me, I don't like Soundhound because it has a relatively high valuation of 10 times sales. It has mediocre growth. It's double digits, but I mean, for a small company, I would like to see that a lot higher. They have very, very low revenues. Annualized revenue is only $53 million, and their margins are decent. What I don't like, as I talked about, is that they're spending way, way, way too much money. Okay, and then finally, let's look at Synopsys, which is the highest rated stock on my list. It's actually, of the 3 we talked about, it's the 3rd highest in total, behind only Expedia and OpenText. And what Synopsys benefits from is a 25% year-over-year revenue growth, on top of $6.4 billion in annual revenue. These guys are just making so much money. They have wonderful margins at just below 80%. They're not spending a terribly large amount of money on SG&A or R&D, and their valuation is relatively reasonable at 11.9. So of the 3 stocks we talked about today, I am a little biased, but I like Synopsys. I also like Palantir. I do not like Soundhound, unfortunately. I like the technology behind Soundhound. I do not like Soundhound as a stock. So what do you guys think? Is there a stock that you would like to see me cover next? Please leave it in the comments. If you have any questions, if you think I missed something, call me out, challenge me. I'm very happy to have a nice discussion, and I hope you all have a wonderful day and a great 2024.